Josh, Toni, Schafer, they've been clients for years, friends for longer. It's been awesome getting to know them, seeing them set up some policies. So I wanted to have them here today to talk about their experience, why we've gotten some whole life policies, and how they're using them. So why don't you guys tell me a little bit about your background, what you guys do day to day, and then we'll get into policies, why you have them, why you use them.
Sure.
So we are involved in multiple different streams within real estate. We do private money lending, and I work with a custom home builder, and I also have my real estate license. So we have different arms of real estate that we're involved in. We also have some rental properties, and kind of transitioned out of the W-2 life so that we could spend a lot more time at home with our kids.
Mm-hmm.
You guys talk about how you guys hard money lend too, private lend to people?
Yep.
We don't do hard money lending, but we do private money. You want to explain the difference?
Yeah, so with hard money, it's typically you just fill out an application. There's no really relationship in that. And then it's all based off of your assets and your debt and all that kind of stuff. And with private money, it is really more relationship based. However, we do a lot of underwriting, and we also will look at your debt to income and everything like that. But it has to do with the relationships. And yeah, so it's a lot different in the way that I guess there's a lot more flexibility, because you can, if you have something good and maybe it doesn't necessarily line up for other people, but if you have people that know you and have your vision, they can come beside you and support you in what you're doing. So that's what we like to be a part of.
Yeah, definitely. So we had talked for years about policies.
Mm-hmm.
What was it that finally got you to the point where you're like, hey, let's start this up? And I believe, Josh, you got the first policy, and then we got policies for your kids.
Yeah.
And maybe Toni at some point we'll get a policy as well.
Yeah, you put us onto Nelson Nash, watched all his videos like, I don't know, 40 times. It took a while just to get my head around the concept of being my own bank. I really liked what everything that you had to say, but it almost seemed too good to be true.
Mm-hmm.
I think for a long time it was just trying to get an understanding of how it worked, how I could use it. I mean, I quickly understood how I could use it. It made a whole lot of sense. But then it almost seemed unattainable. And I think that's another thing too, because depending on where you start, it is like a large chunk of money to get going. And then like the commitment to yourself, because you're kind of making a promise to yourself about like, this is the direction I'm going to go. And it's a full send moment where you're like, you got to just be all in, or you can't like.
Well, I think initially too, we were on more of fixed incomes, and so then it was nerve-wracking to say we don't actually have this money to put into that. Then when we transitioned to variable income, we had the same excuse of like, well, now we don't know what we're going to make, so now we're not going to do it.
Yeah.
And having these conversations with you of recognizing what is the best benefit for our future and what can accelerate us the most, and recognizing that if we needed to make this $50,000 payment a year, that we just knew that in the back of our minds and we would have that money ready, and we have.
Yeah, and I would say when people are looking at funding their life insurance policies, it's a little unconventional, because what we're doing is we're shifting our cash flow into a policy, and we're designing it in a way where it's actually comparable and then will exceed over time another ideal savings vehicle. For example, a high yield savings account at a bank, a CD at a bank, a money market, something of that nature that's liquid, that's guaranteed before you go invest or before you go finance or invest your money. Where do you sit it? And that's why I always ask people and tell them, well, one of the ideal places can be an insurance contract. And what it does is it's not an expense. It's more so you capitalizing a system or a warehouse that now you can tap into. Now, what I hear all the time, and this may also be the case with you guys, is when you have your loan repayments to yourself, right? Because you're essentially becoming your own bank, as Nelson says, right? And you're getting cash in there and you have your premiums coming up. It makes you think about, hey, where's the cash flow coming from? Where's the cash? I got to get the money in there. So it helps you keep more of your own money.
Yeah.
Right.
Well, and that's what we're recognizing already just 2 years into it, which is what we just called you for a month ago of saying, hey, we actually have $25,000 coming in. Can we stick it into the policy now versus when the premium is due, and then working through what that actually looks like to accelerate where we were at.
Yeah.
If you have a thought, you say it, but I don't want to forget the insurance coming in from the car wreck. You were totally not at fault. that
I was not.
the proceeds came in and how we put it into the paid up rider and borrow against it. So
Yeah.
if you want to touch on that.
Well, the only thing I was going to say
It was
about
your idea too. You called me up.
yeah, I
was like,
did. I
pretty
did.
cool.
But to back up about getting the money away from you, I've noticed like, that was one thing. We're good savers. We always have been, but having that money in a savings account always was like a warm safety blanket. And I think it would make me maybe even a little less ambitious with maybe some of the deals that I'm working or other things like that. But taking that money and putting it into a whole life, you don't see it and it feels like it's gone, which is kind of scary at first. I mean, knowing it's there, I mean, you can open it and look at it whenever you want, but not seeing it in my bank account made it a little scary, but then also is like motivation for us to be like, hey, we need to actually keep going here, push harder. We got to make this next payment and all that kind of stuff. So I like it in the fact that it gets it away from you, which when you're first getting into entrepreneurship or building whatever you're building, it's really good to put these, you were talking about vehicles, savings vehicles, and getting other systems working away from your normal system. Because I think when you have it close to you, there's always that tendency to want to use it somehow, or maybe, I don't know, buy that extra Christmas gift or whatever that thing is, because you're like, I've got that
Or
right
get me
there.
a gift.
Yeah, I'm gonna treat myself, and that's fine. And you should have an account to do that. But if you have this in the background working, kind of without you thinking about it, it really helps accelerate where you want to go. And I can already see 3, 4, 5 more years into the future now, this is going to be a really nice chunk that when it comes time to buy that big portfolio that I've been looking at and working for a couple of years, I'm going to have that money ready to go and to use in that.
Well, and I actually felt the opposite, where I didn't like that it was sitting in the bank account. And every time we had a larger chunk, I want it to go into whole life. But that's where it comes into being able to repay that every single year. But to me, it actually feels more comfortable knowing that it's in a whole life and I can take it out when I want. And it's been very easy to use whenever we need it.
Yeah, be able to access.
And quick.
Right.
Yeah.
So let's touch on, you had the proceeds from, got into a car wreck, the insurance company had paid out, said, hey, I got this money. Obviously, when it comes in, you're like, hey, I need to go buy another vehicle.
Right.
Hey, could we put this through the policy?
Yeah.
And more premium, is there room? And we had some more room because it's designed where we can put some additional cash in there.
Right.
And we bought what's called paid up editions. And those paid up editions go dollar for dollar. So the $20,000 we put into the policy, it'll grow with interest and dividends in a tax deferred but really tax free manner if handled properly for the rest of your life.
Yeah.
Give you a multiple and death benefit for you if something were to happen or on to the next generation. Then we simply borrow against it and then now go buy the car. And guess what? Now, instead of using a third-party bank or financing it, we get to repay ourselves.
Yeah. Yeah, I really like that too, because I've always paid cash for cars. I don't like car payments, so I just always like to have the money and put it down. And so this car was paid for with cash. And so I really like the aspect of like, okay, now not only am I paying cash, but I'm paying myself back. So like ultimately, I'm saving twice, because I don't have that car payment that goes to somebody else. So I'm paying, but I do have a car payment that I'm paying to myself with that interest rate that I'm gaining from. So,
we choose the interest rate. That was the other thing that I think is kind of fun. Like we can decide if we want to pay higher interest to ourselves to pay it back quicker, or
choosing your payback schedule and all that kind of stuff is, I mean, you can work with banks and stuff
makes
like
you
that.
feel like you're the boss of what's happening.
Exactly. But what's key about it is the money is going to work within the policy. When we access, while we can withdraw, we borrow against it and leverage against it, because we have the money working in two places: in the policy, in a tax advantageous way, and then we're able to use the dollar in two different places, right? And go finance a car or go finance an investment. Another key is when you're repaying yourself, say you're paying yourself back $1,500 a month in your car payment, or if you loan money out to a deal and you're paying yourself back. Well, after a year, that's like $18,000. And if you're paying back your car, you can't just go refinance your car. Well, you can, but it's not wise.
Right.
But doing it this way, you're recapitalizing your policy, you can tap back into it and do it again for an investment or something else. And you keep recycling, which, as Nelson says, the infinite banking concept. It's the banking, and then infinite's really up to your imagination and how you use it, right?
Which that's actually been the funnest part for us, is thinking about all the alternative ways we can use it outside of what we've learned that people traditionally use it for. even being more creative than what we initially thought that we could use it for.
Yeah. Let's touch on the policies you guys got for the kids,
Yeah.
and then we'll talk about the health insurance and how you
Sure.
funnel cash through the policies for that. So which one do you want to talk about, the policies for the kids and your guys' why behind it?
Sure. Well, yeah, I think it's always good to have a death benefit for any of your family members. Heaven forbid something bad happens, but if it does, it's nice to have that option. And so then I was actually stepping away from my job. We had to move, and there was a few other things happening. So my death benefits and things like that were going to go away when that job ended. And we were looking into what we were going to do for healthcare. And
because you had healthcare through your job.
I had healthcare through my job, and so that was going to change. And so we started looking into what our options were, and we were looking at co-ops and other I don't even know what they're called, like the group,
like Christian Health Shares.
Christian Health Share. Like there's a lot of options out there, but they're not cheap, especially for entrepreneurs. There's just not a lot of good options. And then I was like, well, do we need healthcare? Because we are a relatively healthy family. We're unusual in the fact that we do not go to the doctor regularly at all. I mean, my kids had pediatric care growing up, and then after that, it was like we hadn't really gone back. And so I think for us, it's unique in the way that like our HSA it was built up pretty good when I left my company. And so my idea was, well, why don't we pay ourselves our own health coverage into an HSA account or something like that.
Which we were looking at, the policies were being quoted for health insurance were like $2,000 a month, which was outrageous. But we thought instead of, if that would have been our requirement anyways, we could start putting $2,000 a month into an HSA so that if something catastrophic happened, we would have that account building up, was the initial idea.
Yeah. And then Toni was concerned about, well, what if, catastrophic events happen, HSA is not going to cover that. You're not going to have enough cash in there. And so then we had to really start thinking, praying about like, okay, what does this look like? Do we actually want to go without healthcare? Or what are we going to do? And then I don't even know how you got the idea.
Well, because I was really concerned because I've had friends who've had kids that have died or been in really bad car wrecks or ATV accidents or cancers or things like that where we would be financially wrecked if something like that happened and we didn't have some type of insurance. And so I was trying to think of how could we supplement if some type of catastrophic event happened. And I started getting afraid, like we actually have to have health insurance. And he was asking me, if these things were to happen, like cancer, for example, what would we actually do? And because we don't use Western medication almost at all, we probably wouldn't go the traditional route for childhood cancers and things like that anyway. So we would be seeking out alternative care and paying out of pocket anyway.
And paying unnecessary premiums if you're not going to use it.
Exactly.
Now, what I would chime in and say is life insurance is not health insurance, but these whole life policies do have critical, terminal, and chronic care riders in there, which you have your cash value that gets accumulated, which we're talking about borrowing from and accessing, and you have your death benefit. And the policies we have on you guys and on the kids, those death benefits, in the event they had a significant tragedy like you were saying, you can actually accelerate the death benefit while they're living and borrow from the death benefit to help pay those costs.
Yeah.
Right. So that's a benefit where you guys are like, hey, that can make sense for the catastrophic part. Now, it's not identical to health insurance by any means, and it worked for you guys, unique scenario. But those premiums you're going to pay $2,000 a month per se, we're putting into your life insurance policies, which is giving you cash value that's growing for you for the rest of your life, and you're able to tap into it, when and if you need it. So it actually made a lot of sense.
Well, and we wanted to couple it together, which is why we reached out to you to see if it would work for that, because our intention, even 5 years ago, was that we would be able to purchase a property at some point and for each of the children. And then when they turn 18, they have a choice of either moving into that property and renting it out or selling it and going to college or whatever they want to do. And the way that we were doing real estate at the time, it would have been a very slow process. And so we knew that we needed to start a policy for the kids now when they're really little, so that whenever that policy starts gaining momentum, we can pull from the policy to purchase the property, but then they also have the policy. So now it's going to be kind of a double whammy in that sense of it, but then recognizing that we can use it for we call it health insurance, but like you said, it's not actual health
A
insurance.
pool of money that you can access.
Well, and that's where I
Right.
was going to go with that state, or what the end of her statement there was, that we didn't actually know that the life insurance policy had the pre catastrophic, I don't know what you call it in the industry, but those events that actually you could pull from the death benefit early, and we weren't aware of that. We were just going to use that for the savings vehicle essentially for our, instead of an HSA, because we wanted the flexibility of it. And then you were shared with us, well, there's actually some other aspects of this in insurance that would help.
It
what you guys were
started
talking
because
about.
of the same thing that we talked about with it not sitting in our savings account, but that it's actually in a whole life and building that interest. And then I said, instead of paying it into an HSA, which doesn't gain hardly any interest at all.
And it's restricted on what you can use.
And
it-
that's
and
the
what you
other,
can use it for,
that's
that-
what hung up for me, because
So
I
I
was like,
said-
this is sticky if it's in a
Yeah.
HSA.
I will add with the policy with the kids, while your guys' perspective was this, you take a step back and it actually solves other problems
Yes.
out there. Because a lot of people are like, hey, I want to start a savings account for my kids, of course.
Yep.
And they're like, what about a 529 for education or college? Well, the problem is, what if they don't go to college? What if you need to use it for something else? You have restrictions or penalties, it's tied up. If you have it in an insurance contract, it's going to outpace the savings account, which I just released a video on that too. You could check it on the YouTube channel. But when the cash is accumulating, let's just say kids are 3, 4, 5 years old. By the time they're ready to drive a car, age 15, 16, you can borrow from the policy, buy the car, teach them how to repay it, teach them about money where they're refinancing themselves back, right?
Yep.
They get older, go to college, great. You could use the policy for summer all of college, or you could use it to help them finance a business, trade school, whatever it may be. Then say they go get married. If you feel like, hey, they're up to par where they understand finances, it makes sense, you can actually gift them the policy, and you're giving them a beautiful asset. Whereas now when they pay the premiums, the cash value is going to go up 2, 3, 4 times what the premium is, because you had the long-term thinking
Right.
in place, right? And in the event they were possibly not insurable anymore because something happened health-wise, this death benefit's locked in for life, right? For their family when they have kids and all that.
Yeah.
And that's the other cool thing. Actually, we were just having a conversation with a friend in a car about legacy. And that's one of the things about a whole life policy that really inspires me, is the legacy piece. That not only is good for my children, but it's good for their children afterward. And if you play it right, I mean, if you teach them correctly, it could go on for generations, and it truly can be, a life-changing asset.
Yeah, definitely. Well, I appreciate you guys coming and sitting down. I know we're going to have a great weekend. Here we're up in Ohio at our buddy Todd Fleming and Denise Fleming's event. It's going to be a lot of fun, but thanks for sitting down and taking some time.
Yeah.
Yeah, thanks, Oprah.